UPS stock is down 42% from its COVID highs, currently yielding 5%, the highest in its history. It has a credit rating of A from Standard & Poor. Is it the opportunity of a lifetime to buy into this blue chip dividend stock? Or maybe not? We shall see. Hello and welcome, and if you're new to this channel, my name is Alex, nice to meet you. I'm a retail investor. I'm currently focusing on a dividend strategy where I buy dividend stocks when they have an upside with the plan of selling them when they reach their historical valuation or a fair value, with a focus on stocks that yield above 2.5–3%. So not exactly your classical dividend growth strategy. And if you're already subscribed, I want to say thank you. I just reached 30 subscribers. It's so exciting. It's so fun. Whoever commented and wrote me, so thank you so much. It's really fulfilling and fun to engage with you guys. Please continue writing, commenting. Really, really nice. So yeah, in this video, we're gonna talk obviously about UPS stock. I'm gonna do a brief overview of the business itself, what is currently going on with the revenues, with the profitability. Look a little bit further at current tailwinds and headwinds, and then we'll talk about capital allocation, the debt, the dividend, the share buybacks, and all the juicy stuff, and then get to valuation and just some final thoughts. So this is going to be a little bit of a longer video. Some of you told me they like this format. One of you wrote that they prefer if I could make it shorter. What can I say? I'm gonna try. I cannot promise anything with this video, but it's gonna be a mix. There will be different stocks where I get to deeper to the different depth levels of research and analysis. So that's what it is at this time. I'm gonna try to make it a little bit shorter, but I cannot promise anything. So yeah, let's begin. UPS. So UPS, United Parcel Services, obviously one of the largest logistics companies in the world of shipping, packages, and freight logistics. It operates in over 200 countries. It handles, as of the end of 2023, to 22 million packages a day. It has a huge fleet of the well-known signature brown trucks of UPS, where they have, I think, around 100,000 trucks, and they have an air fleet of around 600 planes, which half of them are owned by UPS, half of them are leased. They have a lot of hubs around the world, in Europe, in Asia, everywhere. Their biggest hub is a mega hub in Kentucky, which processes, I think the official number is like 8 billion kajillion packages a day. They have their, of course, a very extensive network, specifically in the United States, where they can get to rural areas, and they have this big and efficient infrastructure in the United States when they can deliver, of course, using different services all around the world, be it air shipping or ground shipping, and same day delivery, next day delivery, 2-day, 3-day, more of budget deliveries that take longer. Obviously, I think we all know and used that before. So this is UPS, and just they report on 3 different segments, business segments in the company. They have their biggest segment is the US domestic segment, which takes 2/3 of their revenue, which is obviously their business in the United States, which is more the B2C, the more customer and packages. They have 20% is in the international business, and 14% is their segment of supply chain segment, which is more like a B2B services they provide for both small and medium businesses, which is a sector that is growing for them, and different solutions they give to companies where they help manage the supply chain, the storage, the shipping, the labeling, the tracking, and everything that has to do with the shipment of packages that companies need to do. So yeah, the revenue by geography, it's very similar to this segment. We can deduce from that most of their supply chain business also is in the United States, so they're obviously very much affected by the United States, and 21% is international outside of the US. So if we look at just the history of United Parcel, UPS, of their profitability, of their revenues. And we can see that this is a company that has been growing its earnings for a long while. It's been there obviously for a long time. I think like 80 years, something like that. And it has managed to grow pretty well until COVID. We see that it was affected, and we should bear this in mind later in this video. We will come back to it, that it does seem a recession, affected by recession, more of a cyclical business, obviously. When there is a tightening economy, people order less packages and buy less stuff, and as we'll soon see, also choose the cheaper shipping option. So obviously they're affected by a recession, but right now we had a bull market for many years, and we see they managed to grow really nicely during this time. I think the average growth rate, we'll again get to that, was about 5, 6, 7%, depends on which period you look at. And then COVID came, and obviously people were staying at home and ordering a lot of packages and everything they needed to get. They just ordered a delivery home. So UPS really enjoyed from that, and it had a boost in revenues and in earnings. And now we see the correction from it, because people are no longer staying home. So we just kind of getting back to normal. But they do, we'll talk in a minute, face different headwinds right now. And we'll see that what happens when you get this boost in the revenues, that you also increase your expenses. And when the revenues are getting back to normal again, your expenses are still elevated. So we see this, it's not the only reason, but we should expect the earnings now, after the bust, after the boom, to be lower than it was before. It was 8.23 adjusted EPS, and now it's expected to be 7.43. So it is lower because expenses are higher. Not only, but again, in terms of the boom and bust, we should expect that. And now, of course, the forecast that from there, this is going to be again only growth, and we shall see if we buy into the story or not. So if we look at just the trend during the past few quarters of the revenue, we see this beautiful growth still in 2021, where there were still lockdowns and people were staying home. And then in 2022, the trend began to reverse, and the revenues began to fall more and more and more and more. And now it's beginning to stabilize, where the negative growth is smaller and smaller, to the point it's pretty much flat at this point. And what's also important to look at are the volumes, where volumes have always also been reducing. Obviously, people sending again less packages now that they're not staying home anymore. So the volume trend, how much packages are being processed by UPS, the gray line is last year. So it's been negative all the time. The volume was decreasing and decreasing and decreasing and decreasing and decreasing, and it was again still decreasing at the beginning of this year. But now in the last quarters, in Q2, they finally reported that the volumes has gone to positive again, when they managed to increase volumes a little bit. So there seems to be kind of the end of the COVID correction, hopefully. So the volumes are up, but the revenue is not really up yet. Again, it's just a matter of a few percentages, like up 0.5% or down 1%. It's not a big of a difference, but what does pressure revenues at this moment is the product mix, where people do send packages, but because of and here is, we're looking more forward to the macroeconomic headwinds, where there is a little bit of a slowdown, obviously, in the consumer spending and consumer confidence, and people are choosing cheaper shipping options. So even if volumes are a little bit up or flat, those are shippings that are cheaper. The consumers choosing less air shipping and more the cheaper, longer ground shipping, which both brings lower revenue for UPS, obviously, and it has lower margin also. So it pressures the earnings even more. Another important thing to note about the revenues is the Amazon business, which is currently Amazon is the largest customer of UPS. It comprises 10% of its revenues. Amazon is using UPS to kind of complement its own shipping network and shipping capabilities, especially in rural areas where Amazon doesn't have this extensive network that UPS has still, but they're working on it and they're extending it. And gradually they are phasing out of UPS. I don't know if they will eventually break up with them completely, but they're using them less and less as they build their own logistics network. So they use them mostly for that and for in times of peak demand like holidays. So so this is what has been going on lately with revenues. Yes, here we can see exactly what I was talking about, that the volume's up, but the revenue per package, per piece, is down because of the product mix, like I was saying. This is a slide from their last Q2 report. So those were the kind of current trends in their revenues. But overall, if you look, and by the way, they have a great investor relations website where there is tons of information. There are fact sheets about the company and a lot, really very helpful and insightful. So if you're interested, you can find a lot of information there. They have this really long presentation from Investors Day when they have all their strategy laid out. I think a lot of it is too optimistic. I don't know if I will touch upon it more in this video, but yeah, it seemed a little bit too optimistic for me. But anyway, this is from this presentation that they lay out again the strategy and talk about the growth drivers for the company going forward, where some of the biggest one is the revenue from the healthcare, where they provide services for the healthcare industry of logistics and shipping and storage and like cold shipping. Right now, the revenues from healthcare is around 10 billion, which I don't know, it seems super high. I was kind of surprised by this number. I mean, not what I expected, but okay. Another big growth driver for them is the SMB in the supply chain segment, where they provide those services for small, medium businesses and penetrate the market more and more. They have the international expansion. Right now, they're focusing on reducing the costs, and we'll talk very soon about the profitability that is suffering in the moment. So they're doing cost reduction initiatives and cost restructuring. In short, they're reducing their expenses. So they have all those initiatives in technology and IT and managing, and hopefully using less headcount, less people to get the same quality and amount of deliveries. We'll see if they manage to do that. And of course, one of their traditional growth drivers is M&A activity, where they would buy smaller companies, especially to expand their network. So overall, before I talk about the profitability, if I need to summarize the current trends in revenue, it's really hard to know. I mean, there are yes, there are some growth initiatives and there are some growth drivers to revenues. There is a reason to believe UPS's revenues and business will grow from here, but at the same time, they are facing those macro issues, macro headwinds at this moment, like a lot of companies where, again, customers are, people are sending less packages and buying less stuff. So it's really hard to know which one is gonna be stronger. And if the headwinds part is stronger, let me just get back to it, then the revenue could trend down a little further. And I'm not even talking about still about a possible recession, which obviously then their revenues and their earnings would suffer potentially for a few years. So even without that, we're not even in a recession yet, and already, of course, they're seeing, they're already feeling the heat in their in the revenues and their earnings because of the changes in consumer behavior. So I'm not sure which ones of them are stronger, and that's why it's gonna be really hard to forecast even for the next few years the potential growth in revenues and in earnings. So that's probably gonna be one of the biggest points in my video. So that's about the revenues. So if we talk about the profitability, here the story gets even tougher. The margins are really down for the past few years. They have also the increased expenses, where they increased their expenses during COVID, and now they need to tighten it back down. Plus they have the people that are using less air freight and more again, cheaper, longer shipping, which have lower margins. So the product mix is really unfavorable to margins right now. And they have the higher labor costs. And let's talk about the union now. So they have 500 million workers, which is crazy. And then more than half of them, I think, are unionized under this union that works with Teamsters. And the way it works, that every 5 years they have a public contract, the common contract. I'm not sure what the term is, but they open it every 5 years to renegotiate the terms of the contract for the workers. And they just finished this cycle, which from why obviously there is inflation, and we're talking about that they really raised their dividends, and their earnings and revenues have been really up. So the workers are demanding to have a piece of that. So they had to increase their labor costs. Plus there are some more overhead costs relating to that, and they say that most of it is going to be like front heavy, like front loaded in the first half of this year, which is already behind us, and then the last year. So it's in the 5 years, so it's like cycles where they have elevated costs around the renegotiation of this union contract. So yeah, overall, I mean, obviously talking about the benefits, the pros and cons of having your workers unionized is a super political issue. I don't know if I want to get to it too much, but obviously, if UPS, it has its own competition, I didn't mention, but mainly in FedEx and Amazon now, and USPS. And obviously, if UPS is the only one that has its workers under a union that depend really, from what I've seen, high wages, it's gonna be, I'm not saying it's good, I'm not saying it's bad, I mean, in terms of social justice, but for UPS, it's gonna be tougher to compete, no doubt about that. So it is also kind of something concerning, a little bit worrisome. So yeah, so right now margins are really down. We can see here the operating margin and the operating and the net income margin for the last quarters. It has been really trending down. Could it trend down even further? Yes, it could. I believe it's near its bottom. I mean, they have all those costs now, which already materialized in the last few quarters. And the thing with the union also materialized. The unfavorable product mix has already materialized. So this is probably the bottom for the margins. So again, we'll get to valuation, talking about what could be the margins of the earnings power of UPS in the next few years is going to be really difficult, because we see this wide range. I mean, if they make 5% in net income margin, or make it 11 or even 12% in net income margin, and it's about 120-130% difference in the fair value of the company. So it's really gonna be problematic, and this is the case I'm slowly and gradually making in this video. So talking about, you know what, I will make already this point, because why give hints? I'm just gonna say it. I think it's really a little bit of a too difficult pile, UPS, because you don't know, I don't know, the management doesn't know, nobody knows where revenues, where's the trend of revenues is gonna go in the next few quarters, in the next few years, even if without a recession. With the recession, we pretty much know it's gonna go down. And the margins also, the profitability also the same. So it's really hard to value. It's really hard to say if currently it's an opportunity or not. We'll get to valuation and we'll see that in numbers also. But is UPS cheap at the moment? Is it gonna increase in earnings, increase in revenues from now on, and then the price would appreciate? Also, I don't know. It could not. So this is my main case with this video. I don't know. We'll get to that and we'll see that in numbers. Capital allocation, we'll talk about it for a while. We'll talk about the dividend, the story with the dividend, which is an interesting one, and then we'll get to valuation and conclude all that. Capital allocation, let's look at Guru Focus. So the company is, as we said, making about $90 billion in revenues, about 4, 5, 6, 7 in net income. The operating cash flow is about 10 billion, and the free cash flow is about 5 billion. It's pretty stable, and it's what's expected going forward also. So with this, a debt of 26 billion is not too bad. Not ideal. I mean, I don't know. I was taught that you should look at about 3-4 times cash flow, and it's obviously a lot more, but fine. In the universe that it operates, I guess it's considered pretty good. It has again an A credit rating from Standard & Poor's, so that is considered by others manageable and is an okay level. We see that it has a really high return on invested capital, and it's pretty capital intensive business, so it's really nice to see historically, and it's pretty steadily always above 10%. It's very impressive. So overall, it looks like a quality company in terms of capital allocation. There are a few bumps which we'll talk about in a minute, but it looks really nice. I will already mention that it has been buying back shares for over 25 years now. I have a slide we'll see in a minute, but it is buying back shares a lot, almost every year, and it plans to buy back more in the coming quarters also. Overall, capital allocation, nothing wrong there except the things we'll talk about in a minute, but it looks overall like a quality company in terms of the debt and the cash. They're sitting on about 6 billion on cash currently. That's their normal level. But like I said, a few bumps lately. The biggest problem is their cash flow allocation, free cash flow allocation during the past few quarters, and mainly the dividend, which was hiked during COVID, where revenues were high and profits were high and cash flow was high, and it was pretty much obvious it was not sustainable. It was because people were locked down at home and ordering everything home. But UPS, surprisingly, I don't understand exactly the considerations, decided to hike its dividend by 50% in the February of 2022, and that's why the yield currently is really high. It's 5%. It's the highest it's been in its history, and but now the revenues are back down. Just the correction, even without the headwinds, is just back to normal, and the profitability is suffering. But let's say it was back to normal, and now the dividend is pretty much unsustainable. We'll see the numbers in the next slides, but the payout ratio is nearly 100% now. So this is a huge problem, and it's really a little bit of a red flag about the capital allocation and overall the decision making in the company. The management is now saying that they're of course they will always say that they're not planning to cut the dividend, but they plan to earn into it, to grow its earnings into it. It's to show, maybe we'll look at the numbers first. Yeah, well, and then we'll go back to read what the management is saying. So their free cash flow expected for 2024 is 5.8 billion. Their cash flow from operating activities, like we've seen, is about 10 billion, but they have the capex. They're trying to reduce their capex. Will they succeed at that or not? We shall see. But for now, for this year, the free cash flow is expected to be 5.8 billion, and the dividends are 5.4 billion. So they're taking up all the cash flow. The company is currently sitting on a cash of 6 billion. So it's not that they could do this for a long, for many years until they run into trouble. And I will talk about in a minute of the buybacks, but I just want to finish on the dividend. That this is what the company is saying in the earnings calls. So in Q1, 2 quarters ago, one of the analysts asked about it. What the CEO was saying, that we have a disciplined approach when it comes to capital allocation. The first use of our cash, as you know, is to invest back into our business, and the second is to pay our dividend. So the dividend is a priority. By the way, we've seen the scorecard, but they've been paying dividends for 14 years now, so it's not like they have this crazy track record to keep, but it is something. It would be really, I think, hurting for them to cut the dividend, but we have a targeted dividend ratio of 50%. Like I said, I'm not sure 50% of what. Maybe it's from operating earnings, operating cash flow, and then they're pretty close to that. I'm not sure. We are higher than that. It is our intent to earn back into the 50% payout ratio over time. We have no intent to cut the dividend. Of course, they're saying that to make sure that math works. So, first of all, the dividend. I don't get the story. Why did it hike it so much? If it was reckless, I mean, they could have waited at least to see that the earnings, that the hike in earnings, the boom is continuing on, which it was pretty obvious it won't. But even if I'm just now smart in hindsight, I think that they should have been more careful about it. And it doesn't seem safe right now. Of course, they're saying they're not going to cut it, but it kind of looks that if now they're not managing to grow their revenue, like we talked, because they have all those headwinds and the margins are suffering, and they have those elevated labor costs and the lower profitability and cash flows from the unfavorable product mix. So they're not going to have enough cash even for this dividend. Even this small cushion, absolutely tiny, non-existent almost cushion they have now, can disappear in just the next quarter. And then, okay, they're not sitting on, they could raise debt to pay the dividend for a few years. I'm not for them to do that. They might cut the dividend. The dividend might be cut. I think that might be the right thing to do. They shouldn't have raised it so much. So that's my opinion about the dividend. And on top of all that, now they're doing share buybacks also, which they obviously don't have cash for. I'm not sure, again, what are exactly the considerations. The story is they're selling Coyote, which is a shipping brokerage company. So they're going to sell this part and use the proceeding of the extra liquidity, like they call it, to buy back shares, 1 billion worth of shares in 2024. And I'm asking, why? Why? What is that? I don't understand. I mean, they have this. What am I missing? Am I missing something? Please tell me if you understand, and I am missing something. Please tell me. I don't understand that. It's only 1 billion. I get that it's not gonna save much in terms of paying the dividends in the years to come. But again, if they have only this difference of 0.4 billion for the year, again, the cushion of the free cash flow, then 1 billion is something. I mean, just keep it for now, see where things are going. We might be heading into a recession. I mean, it so much reminds me, I talked about in the video of SolarEdge, where when SolarEdge was just beginning, triggered the post-trauma, where they think they have liquidity now, but we might be heading into a tough economic times for the company, which is obviously recession sensitive also. So just keep it for now. you can always buy back those shares in a few quarters, in a few years, when you see that things are going good again and the market is good and the business is good. Why buy back shares now? I don't understand that. I mean, we can all suspect why. So it doesn't look good. It's not a good look anyway. Yeah, so middle of the road thoughts. I don't know where the revenues of UPS are gonna go from now on for the next. I'm not only saying, I mean, if it was only for a few quarters downturn, then and the share price is depressed right now, it could be an opportunity, because eventually it will get out of this rut, and the profits are to be made in this upside. But it could be really a long time. We don't know. Again, some of the headwinds are permanent, and the slowdown in the economy, it's just beginning. And of course, if interest rates are lowered again, then it could give a boost to the economy and a boost to UPS's activity also. But if inflation keeps on raging, the interest rates could go even higher, and then UPS will suffer even more. And then again, there might be a recession also. So just right now, it's not doing great. Even putting the recession risk aside, it's not doing great. It definitely faces some macro issues. So it's really hard to know where and when revenues will go in the next even few years. And the margins even more so, like I said, they probably will have lower expenses, as they should do that. But at the same time, they have this unfavorable product mix, which we don't know for how long it is to stay. Maybe it's a permanent change in the market. And they have this increased labor costs, which just closed this new contract with the union. So this is something also permanent, and in 5 years it's just gonna get worse. So we're going to, again, everything has a price, and we'll do the valuation in a minute. But it's already smelling like a too difficult pile where I don't know. I don't have confidence. I cannot say exactly a good thesis here where I think things will go. So for valuation, let's look at a few methods to evaluate UPS. Let's look at forward PE, then try just to play with numbers and project where the price could be in a few years, and where the EPS could be in a few years. And then we'll look at the discounted cash flows also. So for let's look at the fast graphs. That's why we have it. So we see that UPS has been trading historically around a 19-20 PE. I think let's take out the COVID period, which is obviously a quirky one. So around the 20 PE. I think it's fair. I think it's okay. It was growing 7.5% on average CAGR. So I think 20%, again, A-rated company, dividend, blue chip, loved, known company, 20 PE is really fair. So we could maybe count on it eventually reverting back to it. So the current PE is around 16.4. So from this to this, we have an upside of around 13%. I personally think it's not good enough. And just if in case that I need to clarify that, I'm not counting on this, because again, I do not know if this uptrend will really happen. I think nobody really knows, but maybe somebody knows better than me. But from what I gathered, it could also trend even lower. It could go flat. So if right now the current earnings power, I don't know if earnings power, but the current like EPS, that the only one I could estimate for the next year, 2 years, 3 years, is the current the EPS that is expected in 2024. So that gives us a price of 144, which I don't think is enough of an upside and justifies an investment. So that's in terms of forward PE. But if we try to look a little bit further, of course, we don't want to be like a bank analyst and only see the price target of the end of this year, like a 12 months target. Let's try to look a little bit further, and I'm already saying, I've said, and I'm repeating that again, I don't have the visibility even further, but we're just gonna play with the different scenarios, with the numbers, to see the possible valuations and the possible profitability that UPS can get to in the next few years. I just inserted here the historical numbers just so we have a context of revenue for UPS. This is last year, and this is what is projected for this year, estimated for this year, $92 billion in revenue. Which is a growth of, this is the growth. Let's write that down. Which is a growth of 1%. This is their shares outstanding. This is the true numbers. So let's just talk about next year and then we'll play with it. So if next year the revenues grow 4.5% from the level of this year, so it means that the company resumes growth. It's a moderate growth. They had historically higher growth. I think it's an optimistic scenario. This isn't the optimistic one. So they resume from next year. They resume again the growth of 4.5%. I think is fair. Because they have all those headwinds we talked about also, and they do not buy back more shares. I think in this 854 I already calculated the current share buyback that is planned. I didn't really calculate it. I just threw a number, but I mean it's gonna get lower this year. But I don't see how they're going to have the cash to buy back more shares until they grow their earnings and their cash flow again. And if the net margin, net income margin is going to be around 7%, which is higher than it is right now, lower than it was historical, just somewhere in the middle, the EPS for next year could be 788, for example. Of course, it's very rough. And with the PE of 19, which is the historical, if we can do 20, which is the historical, the share price could hit $150, and from current price of $128, it's gonna be a return of 16% annual, which is really nice. It's great, and plus the 5% dividend. So which is not sustainable, but okay. So this is really the optimistic scenario, and this scenario, and here I continue for the years after that. Every year the growth is going to be 4.5% again. Let's assume the share count doesn't change. Now, the company has been buying shares for 30 years now, 25 years now. So we can estimate that it's going to resume its trend of buying back shares. We can do that. Let's do that. But again, right now they don't have the cash to do that, but fine. Let's do, I don't know, 5 million a year, 3 million a year. So let's go with that. Let's say 800 and 845, 845 again. Let's say this year they won't do, and 840. Okay, so we can. And the net margin, I just played with different numbers because it's so unknown. Again, the range of possibilities. It could go back to like 10, 11, 12%, but it could also go low because of Amazon that is phasing out, and they're working more with, I don't know, Temu and Shein, or just some changes in the market. So I just threw different numbers, and we can use different years to see the different price points. We can play with it. We can say if the margin is 8%, then it's already even higher, even a higher share price. If the margin is lower, then it's a lower share price and lower return of 2%. So I'm even having a hard time to make it coherent because it's too difficult. It's too difficult to value. I don't know. So this is just a case of the revenue is growing, and still I don't know if it justifies an investment. And but if we make the earnings flat for a few years, like flat, and then growth of let's say suddenly, I don't know, 6-7%, okay. Then the returns are even lower. So how do you get to 7%? That's in case the margins is higher. But if we assume that's 7% net income margin, then the return, this is the return from the current price. So it's gonna get even lower. And then if the margins suffer even more, if they won't manage to get back to 10%, then it's gonna be 7, 6, but maybe there will be even a downtrend in revenues. I mean, they have been for the past few years. So maybe if I even do like -2% and -2% and then 0 and then 6, 7, 7, then the returns are even lower. So overall, definitely not a screaming buy. Very hard to value. I feel that it was a little bit unorganized, a little bit chaotic, and I'm sorry about that, but just because it really is just the range of possibilities. We can play with different numbers. I mean, the revenue trend for me is I have no visibility of it. The margin trend, I have no visibility of it. So and this is before I played with the PE, which is now lower because the company is doing worse. So I just assumed the 19 PE that it will eventually revert to it. If I would have adjusted the PE for the when the company is still the revenues are still downtrending 2% a year, the PE is probably not going to be even 19, so it's even lower. So just the range of possibilities, but we see it's not like there is no margin of safety here. It's not like every scenario I do, it obviously has an upside. No, it's not like that. It's really really all over the place, and I think it means that it's somewhere. I mean, in some cases it does have an upside. In some cases it has a really low upside, low expected return from the current price, and in some cases it could get even lower. So there is no margin of safety. It means it's pretty much fairly valued at this point. If that's the way I see it, even if I did not present it very clearly in this case. So the last thing I want to show is a discounted cash flow. I again use a Guru Focus for it. It's just quick and easy. So if we look at a discounted cash flow for UPS, we can do it based on EPS or based on free cash flow. So if we go with the current EPS, let's do a discount rate of 9, and the growth rate, it shows 10% because it had really high growth during COVID. It's not gonna get there. So let's say 5% growth rate, terminal value of 38. So it gives us a fair value of $100 approximately. We can do also the free cash flow, which is kind of stable and expected right now, which is okay, yeah, and we'll do again the 5%, so it's even lower. Maybe we can do a little bit more for free cash flow if they do manage to reduce their capex, so I don't know, 6.5. So we'll see. I don't think there is an upside here. There's no undervaluation here. Not a screaming buy. Again, it could go higher. I don't know. That's the whole point. Let's go back to the conclusions. So, yeah, I think for me, UPS is definitely too difficult pile. I don't see a clear upside here. I think there is no margin of safety. it's a great company. It's a really good company. I would love to own it, but at the right price, which for me would be, I think, below 110, maybe closer to $100. Below 100, I would absolutely drool over it. I think even if you're a longer term investor than I am, that definitely my investment horizon has shortened lately. But even for long-term dividend investors, the dividend is not safe, so do not count on this 5% yield. If you don't mind the dividend being cut in half or going back to more to its prior rate before this crazy 50% hike, and it's still, and from there it will grow. It grew its dividend nicely. So if you don't mind that, and if you take that into account, it could be a great long-term investment for you, where, eventually it will obviously probably grow and get back to its historical PE of 1920, and will increase its dividends, even if it does cut the dividend in the next few years. So really, really, really long time, it could be a good opportunity. And still, you should be prepared for a few tough years. Maybe not, maybe yes, I do not know. And a dividend cut. So that's my overall thoughts. I'm not gonna invest in it right now. I'm gonna wait for a better price. There is a high probability that will happen. If yes, I will be a buyer. If not, there are plenty of other stocks for us to look at. So those are my conclusions on EPS. If you like this, if you stayed so far, oh my God, thank you so much. If you like this analysis, this kind of video, some of them will be again shorter, some of them are gonna be in this format. If you like it, please subscribe. Please write me anything. I love to engage with you guys. So I'll see you in the next one. Bye bye.